How do I start investing? What is a broker account? What is an ETF? What is a stock? If you've asked any of these questions, it's likely because you've seen these screenshots of people posting their Roth IRA with 150,000 in it, or their investing account with close to $1 million in it. The average person sees these screenshots as something unattainable and just a dream. But today, I'm here to help change that. First of all, who am I? I'm Aaron Washington. I'm a financial planner and wealth manager, as well as a capital markets and securities analyst. I study hard so you don't have to. All I need you to do is do me a favor and like this post and share it with a friend or a family member or even your children, because your children need to know how to invest. Everybody needs to know how to invest, and people are not breaking this down simple. So without further ado, let's get into it. What is investing? Investing is simply buying ownership in a company, a business, or an asset. For example, everybody knows what an iPhone is, right? But not everybody knows how to invest into an iPhone. iPhone is owned by Apple, which is a company, a stock that you can purchase on the stock market. If you purchased $100 worth of Apple, anytime Apple company rose 10%, your money would grow 10%. Meaning that anytime a new iPhone came out and everybody rushed to buy the new iPhone, you would be making money. Stocks are just one way that you can make money on the market. There's other ways, such as bonds. Stocks and bonds are two different things. Stocks is ownership in a company. Bonds is lending companies money or government's money. One of the most popular types of bonds is a U.S. Treasury bond because it's backed by the U.S. Treasury, meaning it's one of the most secure investments that you can make. But with secure investments comes lower profit. And I'll go back into that later in later videos. But for right now, an example would be if I purchased a $1,000 U.S. Treasury bond at 5%, in a year, I will receive $1,050, which is my 5% payout, which is almost guaranteed, but nothing is guaranteed in investing. But this is about as close to a guarantee as you can get. And that's with a lot of people with the wealth and a lot of money, they usually purchase bonds because it's a safer investment than the stock market, because you don't know what the stock market can go up and the stock market can go down. So if you want a safer investment, bonds will be where you would want to go. Now keep in mind that bonds can be paid out quarterly, semi-annually, or annually, meaning they can be paid 4 times a year, twice a year, or once a year in one lump sum. So that payment, that 5%, can be spread out among 4 payments of like $1,250 or something like that. Or it can be spread out among 2 payments of $25, or it could be one lump sum of $50 at the end of the year. So that's just something to keep in mind if you're thinking about bonds. Now, mind you, I said that with the safer investment comes lower profit. So why would you put your money in a bond if it's only going to pay you 5% when you can make more money in the stock market? Well, when you have wealth and a lot of money, you just want to protect against inflation. And inflation is something that can eat away your money if you don't know what it is. And what inflation actually is when the cost of goods rise, so the amount of money that you have cannot purchase the same amount of goods that it used to be able to purchase, which means your purchasing power is less every day that you let your money sit still, which is why it's very important to invest your money. If you're not trying to get rich, that's okay. If you want to keep your money, you still need to invest so you can keep what you have. See, everybody who is investing in the market isn't investing to get rich or to make a lot of money. Some people already have a lot of money. They're just investing so they can keep their money and don't let their money get eaten away by inflation. Let me show you an example of how that can happen. See, let's look at a bank account with $1,000 in it. It's sitting there and actually losing money at the end of the year because it wasn't growing. The little interest rate that they give you in the bank account isn't growing enough to really make you any money to compete with inflation. That's why you should invest it. With a bond, you at least make 5% to compete with the inflation. So your money has a little bit more spending power. With a stock, you have even more spending power depending on the stocks that you choose, because sometimes stocks can go lower, sometimes stocks can go higher. But you have stocks that can go up 10%. You even have stocks that can go up as high as 20% and 30% like these right here. And if you pick the right stock or pick the right ETF, you can grow your account by more than 10% a year, meaning that $1,100 could be $1,200 or $1,300 at the end of the year. Or if you had even more than that, it could be even more. So the important thing is to get started investing. No matter what you do, take any extra penny, any extra dollar that you have, put it into some type of account. Open a Roth IRA. open you a individual broker account. Well, how do I open a broker account? I'm going to show you how to do that right here. A broker is basically just a middleman. Think of it like this. The market will not deal with the average person because you have to have millions of dollars in order to trade on the stock market. If you don't have millions of dollars, you cannot place a trade. Brokers, they have millions of dollars. They can place trades in the stock market, but they're willing to deal with the average person like me and you. Just think of it like Walmart. If I want an orange, I can't purchase it from Florida because Florida is not going to send one orange to me for 69 cents. But what I can do is go to the grocery store. The grocery store will sell me one orange, but the grocery store got their oranges from Florida. They had to purchase a bulk load of oranges, like maybe 1,000 plus oranges from Florida, because Florida will send 1,000 oranges versus sending one orange. And that's how the broker works. We can't go and purchase one single share of a stock from the stock market because they're not going to deal with that. But what we can do is we can go to a broker and purchase one share of a stock because the broker has already purchased thousands of shares of stocks from the stock market on your behalf, and they're sitting there waiting for you to purchase it like a grocery store. And just like you have different grocery stores like Walmart or Kroger, you have different brokers like Robinhood, Schwab, and Fidelity. It depends on what your style is and what you like to what you want to choose. Now, how do you open a broker account? That's fairly simple. It's only about 4 or 5 screens. Usually the first screen, they ask you what type of accounts you want to open up. Then they ask you for your personal information, like your address and other little things like that. Then they ask you for your suitability, your risk tolerance, letting you know exactly what type of investments they can allow you to trade. Because if you have a low risk tolerance, they're not going to let you get into something like options if you can't handle the high risk of those type of investments. And that's to protect you from blowing your money and to protect you from making the wrong type of investments that you didn't want to make. So the last sheet should be you funding your account, where you link your bank account to the actual broker account. And this is where you put your money into your broker account. And then you'll be able to trade. Once you have your money inside your broker account, you're now ready to select a stock or ETF or whatever you choose to invest in. What if I'm a beginner and I don't know what to invest in? That's a good question, and that's a question that a lot of people have. If I was a beginner, I would start off with an ETF. An ETF is just basically a basket of different companies, so you don't have to choose an individual stock. You don't have to be a professional to start investing. There's people out there that actually choose stocks, and it's their job every day to pick the best stocks in order to invest in. These people run ETFs and mutual funds. These are ways that you can easily invest into the market and diversify your account without having to be a professional and try to find out which stock is the best, because you have professionals out there that do it for you and they put them in a basket for you. So you can just select which basket that you like better. Do I like my tech stocks? Do I like my Fortune 500 stocks, which is the S&P 500, which is the top 500 companies in America? Or they have other different types of indexes or types of ETFs that you can put your money into that have multiple stocks. That way you don't have to be exactly right on whichever stock that you want to choose. This allows you to be able to enter into the market at a cheaper rate than some mutual funds, because mutual funds are higher than ETFs, and we'll go into that later. But ETFs is a good place to start. I would start with something like maybe the QQQM or the VOO or VTI if I was a beginner. I hope this video really helped y'all, and if it did, do me a favor and hit that like button and share it with a family member or a friend, and help me to get this out to as many people as possible so we can all grow together. 2026 is a year where we all need to be financially responsible and become more financially literate. So let's help each other do that and spread the word and share it with as many people as possible. And thank you for following How to Hire Your Money.